Good afternoon, everyone, and welcome to Unlock the Stock with CA&S. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and to get them to know them and their companies better. This event is sponsored by A2X, a stock exchange that plays a vital role in the progression of South Africa's financial markets. It is the second largest stock exchange in Africa as measured by market cap, with 107 securities listed on the platform, including 21 top 40 stocks with a combined market cap of some 6.5 trillion rand. There's no cost, risk, or additional regulation for a secondary listing on A2X, and it provides issuers investors with the opportunity to save money. The team at A2X is proud to be partnering with Unlock the Stock. Just as this platform unlocks value through insight and key analysis, A2X unlocks value for the stocks listed on its platforms and helps drive the market forward. This platform, of course, would not be possible without our technology partner, Lumi Global, and their website is lumiglobal.com, and you can visit it to find out more about their various AGM and investor presentation solutions. Our hosts will be the finance ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the Q&A after the presentation. We'd like to welcome today Duncan Lewis, the CEO of CA&S. But before we start, a couple of housekeeping rules. CA&S will provide an overview of the group through a presentation, and thereafter you can post questions by typing them into the chat function at the bottom of your screen. This event is being recorded and will be available on the Unlock the Stock YouTube channel, which we urge you to subscribe to. And I'll hand you over to Duncan. So with that, Duncan, please can you share your screen?
Thank you. Good afternoon, everybody, and a pleasure to be with you all. This afternoon, I'm just going to cover a little about who we are and what we do, some financial highlights for the year ending December 22, some market outlook as it pertains to our business and industry, a segmental of the various geographies, some corporate activity that I think is relevant, and then ultimately our journey towards 2026, and then finally some questions. Just a little bit about who we are and what we do. So just as a reminder, our business was incorporated in 2011 with the first acquisition that we did in Botswana, which was of CA Sales and Distribution. However, our businesses go back many decades in these geographies. Some, like, for example, Wito Trading in Namibia, 6 decades, South Africa 4 decades, Eswatini 3 decades, etc., etc. I think the point of that is that we've got deep in-country roots, intimate knowledge with those markets, and local management teams. If I can show you the respective geographies and what's changed since the last time we had this forum, and that is, if you look at Namibia, we did the acquisition of Tabo and Corson, which was the Bidvest company in Namibia late last year. It was approved by the Competition Commission mid-December and effective the 2nd of January this year. In Zambia, we've had Smithshine Enterprise spearhead our expansion into Zambia, and that is our solution catering specifically to quick service restaurants, as well as the convenience channel. And then in South Africa, we did the acquisition of Effective Sales and Merchandising, which is really our part of our channel broadening strategy into the wholesale channel specifically. Just as a reminder of our, our generic services, we have the warehousing and distribution, the retail execution and advisory, the retail support, training and technology and data solutions. From a revenue perspective, warehousing and distribution gives us 8 of the 9.5 billion rands for the revenue, and the retail execution and advisory just short of 1.5 billion of the total. And then the retail support and training, etc., from a revenue point of view, is not a big contributor. But that part of the business is a very important element around informing us around insights, opportunities, gives us a platform to mine efficiencies with regards to resource deployment, etc. Just as a reminder around who our clients are, so from a category point of view, we do food, snacking, treating, personal care products, home care products, alcoholic beverages, etc. And I think that we're very privileged to be able to represent, I guess the top brand owners in the world and in South Africa, and probably, the top 200 consumer brands. If you just look at, the financial highlights, for us are as follows. Revenue for the year ending December, up 18.2% to 9.5 billion. Headline earnings up 33.7% to just over 363 million. Headline earnings per share up 31.2% to 78.2 cents. And then lastly, dividends per share up 30.4% to 15.35 cents. I think that the slide is titled "Our Business is on Track." We set ourselves an objective of a compound average growth rate of 20% between now and 2026. Whilst we talk about revenue growth, it's really around revenue growth is a proxy for everything else. So to highlight this, 2019, we did a revenue of just over 7 billion and a net margin of 2.9%. 2020, that margin remained static at 2.9%. And then in 2021, it expanded to 3.5%. And then last year, we grew the revenue by 9.5%, but also the net margin to 4%. If you just look at this slide, I just want to talk about two things. And, really the GDP forecast for South Africa. I think the point is that South Africa is facing a period of static economic growth. And we have to find our way in this environment, which is obviously concerning. And then, secondly, if one looks around food inflation, so, the numbers, food inflation peaked at 12.4% in December. We expect food inflation to continue at least until the middle of this year. And our concern around that is ultimately around how it affects consumers and shoppers and the impact that will have on the industry and ourselves. If we just look at the segmental overview, I apologize for the busy slide. I think that the only thing I really want to highlight is really just the segmental growth. So if you look at the respective geographies, Botswana growing by 13.6% to 5.1 billion, and that's for the total portfolio of businesses, obviously. Eswatini growing by 16.5%. Namibia growing by 15.8%, South Africa by 34%, and all the other countries are growing over 100%, admittedly off a smaller base. But I think we believe this is important in the sense of what it's going to contribute to our business 2, 3, and 5 years from now, and that's why I mention it. If we just look at the pie graph, I think that well over 50% of our business comes from Botswana, but between 21 and 22, going from 56% to 54% from a revenue point of view, and a fairly even split between South Africa, Swaziland, and Namibia. If one talks about Botswana specifically, the only thing I really want to talk about is the operating profit. Operating profit up 26.5% to 224 million. If one looks at Swaziland, operating profit up 12.8% to just over 108 million. Excuse me. If one looks at South Africa, operating profit up 52.6% to 144.4 million. And then Namibia, operating profit up 70.7% to 43.9 million. And then lastly, all those other geographies I spoke about, operating profit up 40% to 9.98 million. If you look at the corporate activity, you heard me talk about the T&C transaction earlier, but we did the Tobin transaction. We acquired the full ownership of Effective Sales and Merchandising, which, as a reminder, was the acquisition we did in South Africa. And then we acquired a controlling stake in Visible Works, and then lastly acquired full ownership of Promex, which was our Zambian retail execution business. But if you add up all the activity from a revenue point of view, it contributed certainly no more than 300 million rands worth of revenue to our business last year. And then we expanded into Zambia, as I said. We increased our stake in Logico Couriers, and then established SMC in Lesotho, which is our distribution solution in Lesotho. If you just look at the journey towards 2026, I think we've been fairly open and upfront around having an ambition to be a 20 billion rand business by 2026. I think that if you look at the building blocks between now and then, I think that we believe that we've got the framework in place to take us to around 18 billion. And then the difference between the 18 and 20 is around strategic acquisitions and potentially new geographies. I think the point of the slide is really where we've been and where we set ourselves, the objective we set ourselves going forward. I think that if one looks at our strategic priorities, I'm not going to unpack all of them. I'm just going to talk about some as I see it, and that is first priority is to defend the core and make sure that we deliver for existing clients and continue to deliver efficiently and effectively. The other one is around expanding with existing clients in new geographies. In the context of our revenue plans, the single biggest opportunity we have is to expand with existing clients in new geographies. And in my view, that represents a 3.5 billion rand opportunity, hence the prioritization of that. And then expanding our geographical footprint in predetermined markets. So we're very much an African business, an African-focused business, but we've prioritized some markets, and it's important that we establish solutions in those. And then some strategic acquisitions. We have an eye on some strategic acquisitions that will enhance our offering to existing clients, make us a better business, in other words, improve the DNA of the organization in terms of insights and understanding, and then lastly, ones that are margin enhancing. And then the other one is around expanding services to existing clients in the like of online and e-commerce, and making sure that we are, performing in that particular channel and taking advantage of those opportunities. I think that we continue to have a robust new business pipeline. We're working hard on new business every day, and that is an important foundation for our future success. Just on the financial performance, I'm just going to single out a few areas, and I'm going to ask my colleague Rech just to talk through a few of these highlights. Frans, if you wouldn't mind, please.
Thank you, Duncan. Good afternoon, Africa. This is the numbers. This is our scorecard as at the end of December. And this slide just shows us the revenue growth from 2016 to 2022. Good growth from 2021 of 18.2%, flat on 2020 and 2021. Was a period we all went through. The whole world was in disarray, but that was the effect that we had because of that period. Now, if the next slide was our headline earnings per share slide of all of the similar periods, and it just shows that our revenue and headline earnings per share trend is similar. The next slide is our income statement. just a few line items there showing us the growth on from the previous period. And I think it's the numbers speak for itself. What I always say, it's I mean, that was end of the year. The business is still running. We still it doesn't stop at a certain date. This is the date of 31 December, and we are proud of our numbers that we achieved in 2022. Just the balance sheet. There's some movements on our our assets. If you look, there's about 200 million. But the biggest portion of that relates to the IFRS 16 charge, which is a technical thing. Our accountants will understand that, which is the rental that we had to recognize. Then a similar amount of 100 million in the liabilities. And we achieved just over 17% return on equity in 22 compared to 21's return on equity of 15%. Working capital. Our business is driven a lot on working capital. So a lot of our money, of our cash, is invested in working capital because that enables us to drive revenue. As you can see, at the date of 31 December, which were a Saturday. Unfortunately, some people doesn't work on a Saturday, and look at planning the New Year's celebrations. So we a little bit concerned, not concerned me, but it was just a timing period of working capital that increased from the 2021 numbers. But we also invested in stock because of service levels issues that we experienced in the previous periods. On the cash flow, you'll see also there, just to highlight the working capital, the 149 million increase in working capital, but it's also just a timing issue, and we're not really concerned on that investment need. And in something that I always say is that, I mean, if you look at the taxes paid, we paid about 150 million in the group to the receiver of revenues in the geographical areas. If we pay taxes, we make money, so we're happy to pay taxes. And that's free cash we could generate of 251 million, also a timing period, but we are cash generating business. Thank you.
Thank you both for that. I'm now going to actually hand you over to the finance ghost, Mark Tobin, who will be facilitating the Q&A. As a reminder, please post your questions into the chat function at the bottom of your screen so that they can be dealt with. And we look forward to that Q&A session now. Thanks.
Thanks, Deborah. I might just kick off the first one. Duncan, this is your second time presenting, and after the last event, we had a question or two around, what's the kind of moat around CA&S's business? How difficult would it be for somebody to compete with you or, take over, Nestle distribution? Maybe just give us an idea of, what would be, the requirement in terms of like working capital and systems and operations to, to actually come in and, try and take over, certain brand lines within the CA&S Group, whether that be just for South Africa or, doing their whole Southern Africa point of view. Because I think, from my point of view, the sheer scale of the business is a moat in itself.
Yeah, thank you, Mark, and good afternoon to you. I think that if one talks about a moat around the business, et cetera, I think that notwithstanding the issues you've spoken about, I would say, the single biggest thing is to ensure that, A, we remain efficient, and B, that we continue to deliver results for existing clients. If we do those two things, I think that we more than halfway there. But I do think that in an attempt to answer your question, is that we're employing 12,500 people across these geographies. Those people are onboarded, they are trained, they have the skills and the technology to perform or execute the tasks that we report to them. and that they report back the successes. Now, that is not easy to get overnight. It's taken us several decades to get here. So in terms of, the moat around the business, notwithstanding the obvious things around investment in working capital, investment in infrastructure, systems and processes, it's around the skilled feet on the ground that makes the difference. Bearing in mind, we have the technology to understand exactly where everybody is at any time of the day, what tasks they were meant to do versus what they did do, and what those exceptions are. So I think you add that all up together, I think that becomes a significant barrier to entry, but never say never.
Duncan, Franz, congrats on some pretty rocking results. It's really good to see. Thanks everyone for joining us on Unlock the Stock. So my first question is around inflation, and obviously that's the theme of the day. Will we or will we not see another rate hike today out of the MPC? We'll see, but the reality is that inflation is here. It's not quite going away as quickly as people would have liked. Is the business a net beneficiary of inflation? Just looking at your results in this environment, do you think that, obviously at the top end of inflation, volumes start to really dive in FMCG. So there will be a point, I suppose, at which it starts to hurt. But I guess just some commentary to help people understand, is inflation good for you, bad for you, indifferent? It's obviously very relevant to the year ahead.
So if you're talking about 2022, and please, Franz, feel free to come in here. I would say that we were a net beneficiary of inflation in 22. And that is because we managed our costs. And so, I think that the important thing for me is to manage our costs and manage our costs below inflation. And if we're able to do that, we certainly won't be worse off. I think, of course, there's pressure on costs everywhere. It's important to ensure that we're doing all we can to manage costs and manage the price that the end consumer pays.
Duncan, just another one for me when we talk about costs. We've seen a nice tick up in the margin, as you pointed out in the presentation, from 2.9 to 4. Can you just give us a bit of a more of a deep dive into, what's driven that? Is it, coming from more scale within the business from the acquisitions and just the organic growth? Or is it, a change in mix with, South Africa becoming a bigger part and Botswana going down? And I guess, is there scope to drive it even higher on your 2025 plan?
Yeah, so it's not it's a nuanced answer. So just bear with me, please, Mark. So I think that first of all, you mentioned South Africa. South Africa is less than 15% of our revenue, but that is our services-based business. So our services-based business, generally speaking, is margin richer. In our services-based business, we got the mix right. So in other words, we have the 5 operational divisions. And we believe that we have the right mix of clients, bearing in mind that we're offering by and large a synergized solution. And you see that the revenue increased by 34%, but the operating profit, I think, was north of 50%. That is certainly a contributing factor to the overall margin. But if you look at our Namibian business, which is another issue, our Namibian business has really been, pedestrian for the last 3 or 4 years. Some of it of our own making. In other words, we were in I think it was a 5,000 square meter facility. And frankly, we didn't have the capacity to take on new clients. We commissioned the new facility, which took 18 months to 2 years to get into place. We moved in there in December 21, and we had a full year last year in our new facility. So we've gone from the 5,000 square meters to 12,000 square meters, which means that we were able to take on new clients. And so you'll see the revenues increased in that business, but also, we've made a small profit in that operation. I'll be the first one to say is that our business in Namibia has been underperforming, but as I say, some of it is through our own doing, and we have seen it last year make some money, and that will certainly continue into 2023. Lastly, I would say as a general comment, Mark, is that if you remember me talking about the core services around warehousing and distribution and retail advisory services. We're seeing the contribution from retail advisory services increase as a total percentage of revenue, and that is the third building block of margin. So, of course, it's been very intentional and deliberate, and I'm, I guess, very grateful that we've been able to grow the margin from 21 to 22.
Perfect, thanks.
Speaking of regions, I'd like to understand a little bit more, as I'm sure with everyone else, just about the way you think about these regions. So a lot of the financial reporting is based on regions, but of course that financial reporting isn't always how you actually think about the business. So is it a case of saying we target a specific country and then we figure out what services roll up into it? Or does each business say, no, we think that country looks good, and then when it's financial reporting time, it's a case of, you know, okay, who are all the businesses that are in this country? Let's roll them up. Obviously, I'm being facetious, but you get the point. Is the strategy country driven, or is it business unit driven? And then they just happen to also operate in the same country as each other at times.
You know, the way I look at it is that, you know, let's just assume we're entering into a new market. I look for a business that is either number one or two in a particular market. Look for a business that has a history of making profits, and do they have a management team, frankly, that we think is competent and that we can trust and that we can partner with to get accelerated growth. That would be my first conversation or port of call. I think that for me is to ensure that whatever we do, we can provide a credible solution to our tier one brand owners. So whatever area I participate or channel I participate or geography is that I've got to have a market leading solution in place to complement the market leading brands that we represent. So I would put my foot into a new channel, make sure I perform and grow the business from there. So we look at the businesses not only from a geographical standpoint and try and understand what the overall opportunity is for what I would describe modern trade, general trade, wholesale, and what we need to do in those markets, but what are the channels we need to service and build the business from there.
Another one I saw in the results, you know, you've tidied up a few minority interests, you know, gone to 100%. I'm just wondering, you know, with the ownerships, are you agnostic of, you know, having, you know, 80 and maybe the founding family or business owners remaining 20, or is it kind of the long-term goal might be a bit of a phased purchase plan, you know, a bit of an earn-out that you always get to 100%, or are you happy to, you know, stay at 80 if the founding family want to keep 20?
You know, I think it's a yeah-near answer, Mark, which I hope you understand. But I think that what's important for us is that we have a leadership team in place in the business that is committed and has skin in the game. So generally speaking, the way the business has evolved, we've always bought owner-operated businesses, and bought a minority stake to get to understand the business, get to understand the people, and ramped it up, you know, 35, 60, 100 over a period of time. And that, generally speaking, has been the formula. But in some cases, if you take our business in Eswatini, Logica, we bought an initial stake in that business in 2011, and it was only in 2022 where we had bought the final 100%. What I want to stress is that that management team shares have been converted to the top. Are you with me? So management continue to be what I would describe as significant shareholders in the business. The other thing is around the exceptions to that. If you take our South African business, our staff own 25% of that business, and they have done so since 2005 through a staff trust. And that is an important part of how we reward years of service, ensure staff retention, and you know, I think it's also an important part of us remaining at a BE level 2. So I think that for us is strategic. It's worked very well for us. And, I think that if one looks at it at a staff turnover point of view, I think that we probably have, if not the lowest, certainly one of the lowest staff turnovers in our industry. And I think that is a contributing factor, sir.
Thanks.
Duncan, don't worry about Mark's Afrikaans. He married into an Afrikaans family and he lives in Stellenbosch. I promise you, he knows a lot more than you are near. That I'm very confident. Don't let that accent fool you. I've got some questions. Yeah, exactly. I've got some questions coming through in my DMs, which is always good to see. So please keep them coming. So the first one is, what do you see as the biggest risks to your 2025 targets, biggest risks? And just high levels, sort of the plans to mitigate that. I know it's quite a big question, but just to give people a sense of, what are you worried about over the next couple of years that would stop you getting there?
I think that I would divide it up into two categories, and that is the stuff I've got control over and stuff that I don't have control over. So me talk about the latter, stuff that I don't have control over are things, for example, like a global economic slowdown. I guess this war in Europe gaining momentum and the implications for that. One talks about, closer to home, South Africa, load shedding and the impact thereof, et cetera, et cetera. So those are things that we've got to understand and navigate and, weave our way through to ensure we understand them, mitigate the risks those present, and we just got to be nimble and, future focused. But from, closer to home is that, for me, I think it's really important for me that, in my view, our business has been built on three things. One is what I would describe as capability building. The second thing is around operational excellence. And if we've got capable people equipped with the right skills and tools to do their job, we can expect the operational outcomes. And operational outcomes, to be clear for me, is around availability of stock in store, visibility of it. Are we looking after the looks of success? Are we growing categories? Are we growing brands? If we are delivering those operational outcomes, our accelerated growth ambitions will happen as a consequence of those. So I think that, for me, is to ensure every day, are we investing in the right areas, doing the right things? Are we getting the right behaviors in store, on shelf, consistently? And, we watch those two things very, very closely. And, I think that our success will come as a consequence thereof, or lack of success for that matter.
I've got one here from the audience, Duncan, just on the funding of acquisitions and how you think about that between, taking cash from your own balance sheet, taking on debt to fund an acquisition, obviously being listed, scrip is also an option in terms of, getting, shares in the holding company listed here now on the JSE. It's a bit easier now that you're out of the PSG group. So in terms of, when you're looking at an acquisition, is there a certain mix that you'd like to go in with? As you say, you like to have management incentivized. So I'm guessing, a bit of equity or them retaining their own equity. How do you think about that?
I think all those options are available to us, but I think that for now, if you look at the journey between now and the 18 billion, I think that we're fairly confident that, we can fund our own growth, I think, and walk the tightrope between dividends, CapEx, and funding the growth of the business. I think that if a particular opportunity comes along, I think that we'll look to fund it through, cash and debt, and then potentially even script. So, I think that we're open-minded, but for now, I think that we're fairly confident we can fund our own growth. So,
I'm going to ask.
Yeah.
Sorry.
No, I beg your pardon. I just wanted to see if my colleague Frans wanted to expand on anything.
No, nothing. There's all those venues are available for us, and it depends on the opportunities at the end of the day.
Frans is still shell-shocked that Mark can speak such good Afrikaans. I'm going to ask you guys a follow-up question around capital allocation, and that's around share buybacks. Someone's mentioned here an odd lot offer. That's become kind of the flavor of the month. Easiest 7% you'll ever make in your life is if you get an odd lot offer correct as a trader. You don't get a lot of money, but you get a nice percent. Just, around obviously the share price, your liquidity. So just a question around how you think about returns to shareholders, I suppose.
Yeah, I think that I'm no expert in the area, but what I will say is that we've gone from what was previously I would describe as a handful of shareholders to tens of thousands of shareholders. I think that we are trying to understand what the share register looks like, and the granularity of the shareholding. Who owns what, and it is certainly something that is being considered. It's an option available to us, but no firm decisions as yet. But it's certainly on the agenda.
And another kind of question around acquisitions, Duncan, more from a regulatory point of view. In some of these smaller markets like Namibia, Botswana, in terms of the competition regulators in those markets, getting concerned about how big you are as a part of the overall market. Probably not too relevant in South Africa currently, given the size of the business here. When I've got plenty of other big players, but yeah, does that become somewhat of a limiting factor in terms of looking at acquisitions in some of the smaller markets?
I mean, I think that as you correctly said, it's very market specific or geographical area specific. So, if you look at my most recent experience, which was Namibia, where we bought the TNC business, and I would describe the TNC business as a number 3, right? And sorry, my computer wants to do an update, which is disappointing. So just bear with me, please. Are we back, Mark?
Yeah, no, we never lost you.
Okay. I beg your pardon. So I was saying my most recent experience was Namibia, where we bought the number 3 player. I would describe us as a number 2 player. So essentially the number 2 player bought the number 3 player. And obviously it was subject to the regulatory approval. But in markets like Namibia, they're fairly small, and the market can't support too many companies, to be blunt. And so I think that plays a role as well. If you take our South African business, I think that whilst we have a fairly big business, we're a fraction of the size of what I would describe as the number 1 by revenue. And in fact, I would say they're probably double or even triple the revenue that we are in South Africa. And there are many other service providers in that space. So I think that where your question would be most relevant is around Botswana, which is 50% of our revenue, where I think that we have a fairly big footprint. But even so, there are several channels we don't play in. For example, if one talks about pharmacy distribution, one talks about hardware, one talks about so-called white goods. We don't play in those spaces at all. So I think that if we had to do an acquisition in pharmacy or hardware or white goods, I mean, I'm not concerned about that. Perhaps in the grocery distribution, yes, I think it would be an issue.
Mark, just from my side, I mean, the regulatory, they do their work, and so far we really been assisted with in a lot of these cases. So I think it's a good thing in the countries, and we comply to that, and it keeps us also straight.
Yeah, perfect.
Another one from me around your plans over the next few years. So I had a question here in my DMs. What is your guidance for return on equity expansion over the next few years, and sort of what are the main drivers of that, and could that change over time?
I think if one talks sort of from a return on equity point of view, I think the number for 22 was 17.4%. But I think that what success for me is north of 15% to have return on equity between now and 2026 of north of 15%. Some geographies will deliver more, some less. So if we enter into a new space, I think that they'll grow into the ROE going forward, but on average north of 15, sir.
While Mark's looking for the next one, I'll tell you, if you need to get those returns somewhere, I just got a fun comment in my DMs that apparently you are badly needed in Mauritius because the services are not great there. So if you fancy some good seafood in a hotel while you go do a DD there, apparently Mauritius needs you.
I welcome any leads to pursue opportunities there.
There we go. All the corporate financiers on the call. There's a nice in fee.
In terms of the South Africa business, is, you talked about getting into some of the lines in Botswana maybe that you're not currently considering. Would that also be an option for the South Africa market, or is there more than enough kind of opportunities just doing what you're doing, grocery and the retail support services in South Africa to not think about going down some of these other lines?
Look, I want to remain very focused as a business, Mark. So when I talk about hardware distribution, whilst it remains an opportunity, it's certainly not something that's on my radar in the next 24 months. So I think that I want to remain really focused in the channels that we currently serve. And I'll take a lot of my leads from my clients. In other words, if my clients are looking for a solution in a particular geography, I will take that seriously. If my clients are looking for a particular solution in quick service or in forecourts or in general trade, I will look at those. So I think that what I'm trying to say is that in many respects, I have a client-led growth strategy. So taking existing clients into new channels or geographies, and that will inform a lot of our decision making and plans.
I've got an interesting one for you. I don't think we've been asked this before on Unlock the Stock. Drum roll, please. So people looking at sort of your typical mid-caps, I think it's a great question, which is to understand the shareholding profile a little bit better. So just roughly like percentage in the business held by management, sort of your anchor institutional shareholders, and then a little bit of sort of the retail float. Might be a tough number for you to have off the top of your head, but any commentary around just some of the percentage holdings there. I think especially around management interest in the business, that's probably something that people are focusing on.
Yeah, look, I'll hazard a guess. I said is that, we've gone from a handful to tens of thousands. So, so just bear with me. But I would say management would own probably just south of 10%. France, is that right? Just south of 10%, sir. And then, the institutional shareholders would have a great deal, but France is just looking it up. So just bear with me, please. Yeah.
It's basically, on the integrated report, we will do a proper analysis of the share register. But as Duncan alluded, is I think on the share auction side is limited to 5% of the total shares, and then because of the roll-ups of other management, that adds up to just below 10%. And then other shareholders, to be honest with you, if you want to know, is you just need to look at the PSG capital when they were still listed, the PSG Group. That's very reflection of exactly the same shareholding.
I've got one here on integrations, Duncan.
I beg your pardon, Mark, but I think that we're very happy to go back to the institutional individual ask the question once we understand the granularity of it, and we can send it via yourself. So just we can come back to that if you don't mind.
100%.
As we said, there'll be a bit more detail once the integrated annual report comes out as well. So they can check in the notes at the back. Just on I got a question on integrations and synergies. If maybe we can talk to the T&C acquisition in Namibia. You talk about the new facility you had there. More than double in size, going from 5,000 squares to 12,000 squares. Do you then take basically the T&C business and integrate it into that new warehouse to fill it up, or does you leverage off of T&C's existing kind of warehouse and distribution nodes on top of, you know, what you've got already yourself?
Yeah, you know, I think if I can just park the TNC thing for 1 minute, I think that our approach to running these businesses is to give the local teams, you know, I think a lot of autonomy to run the businesses as they see fit. Bearing in mind, we've been in these countries for several decades. The management team is well seasoned, they experienced and know what they're doing. And so, you know, I think that we give them a lot of autonomy, but in return for that, we expect them to be accountable. And so I think that we're I guess we're fairly tough around the accountability bit. We provide a framework around certain things, whether it's finance, governance, processes, etc. But certainly we're not getting involved in telling them who to hire, when to hire, etc. It's important for me that every single operation is, I guess, is profitable and makes its own contribution. I think that head office consists of 6 people. Head office consists of 6 people, and I have no intention of growing head office between now and 2026 beyond the 6. So, you know, I think that we're a very operational focused business, but we have a very intimate relationship with the senior leadership team across the group. And so if you look at our purpose as a business, we talk about the power of and there's a lot of cooperation across the businesses around understanding what best practice is, how we replicate best practice, how we develop people through the organization, and that might be lateral promotions from one geography to the next, and that we're doing a skills broadening thing. And when it comes to new business, we hunt as a pack. So in other words, we don't have business in this geography, but we do it in these 3 geographies. How do we successfully bring this client across the line to a new geography? So I think that I'm not saying it's perfect, and I'm not saying we don't have areas of improvement, but by and large, we've got the balance between accountability, autonomy, and making sure we're all pulling on the same rope.
So the local manager, they're in control of their own destiny with kind of the head office support structures around them to kind of, I guess, do what they need to do on a day-to-day basis.
Yes, and also, you know, Mark, I think that from an operational point of view, we're operationally very involved. I mean, we probably travel for 6 months of the year. We're in the regions, we're walking the floor, working with management. And for me, I don't see, you know, I don't see it working any other way, to be honest.
It's a fun insight that we have 1/3 of the head office on this call. I like that. So it kind of alludes to actually what I was going to ask you next, which is a little bit around net income margin expansion. So one thing that's cool with your story is there's a little bit of law of small numbers here. You know, for a company to go from a net income margin of 15% to 30% is very unlikely. But to go from 2% to 4%, yeah, you know, you've gone from 2.9, I think, in 2019 to roughly 4% now.
Yes.
You know, obviously economies of scale coming through there. It's always, I always write about it fairly often. You know, you see a relatively modest revenue growth that ends up being a lovely earnings growth at the bottom because of operating leverage, economies of scale, and you guys are not short of top line growth. So I think maybe just some comments on, you know, where can that net income margin actually get to? How big is margin expansion a part of your plans? Just anything around that I think will help the investor base understand the opportunity for you.
Yeah, look, I think if I could write the script is, you know, to do the 20 billion and, you know, the net margin to be anything between 4.5 and 5. I mean, if that's I wrote the script. And what's important around that is to find the balance or the mix between warehousing and distribution services, the data insights and the commercialization of that, getting that mix right. So that's what it'd be if I wrote the script. But also, you know, I think that if one talks about brand owners and retailers, everybody's under pressure for margins and volume growth. And we've got to walk the tightrope around margins and margin expectation. And so we need to make sure that we are competitive and that we strike the balance between our margin providing value and being short-sighted, frankly, and greedy.
So a little bit more margin expansion, and then most of it will come from sort of top line from the sounds of it.
Correct, yes, sir.
I don't have any further questions in my DMs, so the finance desk, if you've got any others there you want to chip in?
No, I think my DMs are done. Just some appreciation messages in there. So well done to the team from CA Sales. Thank you so much. And yeah, I think we're probably done.
Thank you. And, I really appreciate your interest in our business and, extend that to your audience. So thank you.
Thanks, Duncan. Thanks, Frans, for joining us.
Thank you very much.
So thanks. That seemed like a very good Q&A session. And I'd like to just thank everybody who participated in Unlock the Stock today for your participation. Always good to have such robust conversations with retail investors particularly. And a special thank you, obviously, to Duncan and Frans for making the time to support this investor platform. And a reminder, if you'd like to be added to the CA&S contact database to receive their notifications, please just email investor@cas.group. We hope you enjoyed this event. And if you'd like to listen to it again, we'll be live on the Unlock the Stock YouTube channel shortly. Sorry, not live. The recording will be there. And just a final reminder to please join us for the next session of Unlock the Stock on Thursday, the 13th of April, to hear from Astoria Investments. So please keep a lookout for that invitation. And final goodbye from my side and the rest of the team. Thank you so much.